Welcome to Lesson 14.9, Corporate Sponsorships versus Grants. This lesson addresses a distinction that confuses many nonprofit professionals and creates significant compliance risks when misunderstood. Corporate support for nonprofits takes multiple forms, and the differences between them matter enormously for tax treatment, accounting, donor relations, and organizational strategy. When a corporation provides funds to a nonprofit, that transaction might be a philanthropic grant, a marketing sponsorship, a fee for service, or some hybrid arrangement. Each category has distinct characteristics, creates different obligations, and requires different handling. The IRS, your auditors, and corporate partners all care about getting these distinctions right. This lesson focuses primarily on distinguishing philanthropic grants from marketing sponsorships, the two categories most frequently confused. We will examine what makes each category distinct, explore the tax implications, particularly around unrelated business income tax, or UBIT, discuss how to structure relationships appropriately, and address common situations where boundaries blur. Tax treatment of sponsorships involves complexity that requires professional consultation for specific situations. Our discussion provides conceptual framework rather than tax advice. Always work with qualified tax professionals, whether CPA or enrolled agent, when structuring corporate relationships with significant financial or compliance implications. Before distinguishing sponsorships from grants, we established the broader landscape of corporate support for nonprofits. Corporations engage with the nonprofit sector through multiple mechanisms, each with distinct characteristics. Corporate foundations are separate legal entities established by corporations for philanthropic purposes. These foundations operate under the same rules as other private foundations, with required payout rates, prohibited transactions, and oversight requirements. Grants from corporate foundations function essentially like grants from any foundation. The corporate connection may influence priorities, but does not change the philanthropic nature of grants. Corporate giving programs provide support directly from company operating budgets rather than through separate foundations. These programs might support employee volunteerism, make charitable contributions, or respond to community needs. Direct corporate gifts are typically deductible as business expenses or charitable contributions, depending on structure. Corporate giving programs often have less formal processes than foundations. Sponsorships involve corporate marketing investment associated with nonprofit activities or events. Unlike charitable gifts, sponsorships are business transactions where corporations receive value in exchange for payment. The corporation pays for brand exposure, association with causes, or access to audiences. Sponsorships are marketing expenses for corporations, not charitable contributions. In-kind contributions provide products or services rather than cash. Companies might donate inventory, provide pro bono professional services, or offer use of facilities. In-kind contributions raise their own valuation and accounting questions. Understanding what form corporate support takes is the first step toward handling it appropriately. Grants from corporations, whether through corporate foundations or direct giving programs, follow the philanthropic model we have discussed throughout this course. Understanding grant characteristics helps distinguish them from sponsorships. Charitable intent defines grants. The corporation or foundation provides funds to advance the nonprofit's mission, not to receive commercial benefit in return. The motivation is supporting good work in the community, enhancing corporate reputation through association with important causes, or fulfilling corporate social responsibility commitments. The giving reflects philanthropic values rather than marketing calculations. No substantial return benefit flows to the donor in grant relationships. The nonprofit receives funds and uses them for charitable purposes. The corporation receives acknowledgement and satisfaction from supporting important work. There is no commercial exchange, no quid pro quo where payment obligates the nonprofit to provide services or exposure with advertising value. Donor acknowledgement without advertising value is appropriate for grants. Nonprofits can thank corporate donors, list them in annual reports, and recognize their support publicly. This acknowledgement crosses into sponsorship territory only when it constitutes advertising, meaning when it promotes corporate products or services, contains calls to action, or provides value that the corporation would otherwise purchase. Tax deductibility as charitable contribution characterizes corporate grants. Within IRS limits, corporations can deduct charitable contributions. Grants to nonprofits typically qualify for this treatment when they meet charitable contribution requirements. Grant agreements focus on charitable purpose, describing how funds will be used to advance mission, what outcomes are expected, and how the nonprofit will report on use of funds. Grant agreements do not describe marketing benefits the corporation will receive. Sponsorships operate under a fundamentally different model than grants. Understanding sponsorship characteristics prevents misclassification that creates compliance problems. Business transaction with reciprocal value exchange defines sponsorships. The corporation pays money and receives something of value in return. Both parties benefit commercially. The nonprofit receives funding while the corporation receives marketing exposure, brand association, or audience access. This reciprocity distinguishes sponsorships from charitable gifts. Corporate payment for promotional benefits represents what sponsorship fundamentally is. Companies sponsor nonprofit events, programs, or organizations because doing so provides marketing value. Association with respected causes enhances brand reputation. Visibility at events reaches target audiences. The payment purchases something valuable to the corporation. Advertising, logo placement, and naming rights represent common sponsorship benefits. Corporate logos displayed prominently at events, on materials, and in communications provide advertising exposure. Naming rights for events or programs create ongoing brand association. These benefits have commercial value that corporations would otherwise purchase through traditional advertising. Access to nonprofit audiences and events provides additional sponsorship value. Hospitality opportunities at events, introductions to other sponsors, and access to nonprofit networks offer corporate sponsors valuable business development opportunities. These access benefits may matter as much as visibility benefits for some sponsors. Marketing expense for corporations rather than charitable gift describes the tax treatment. Sponsorship payments are business expenses that corporations deduct as advertising or marketing costs. They are not charitable contributions. This treatment reflects the commercial nature of the transaction. IRS rules create specific distinctions between qualified sponsorship payments that do not create taxable income and advertising payments that do. Understanding these distinctions helps you structure corporate relationships appropriately. Qualified sponsorship payments involve payments where the sponsor receives no substantial return benefit other than use or acknowledgement of the sponsor's name, logo, or product lines. The key question is whether what the nonprofit provides goes beyond acknowledgement into advertising territory. Use or acknowledgement exclusion allows nonprofits to acknowledge sponsors without triggering UBIT. Simply using or acknowledging a sponsor's name, logo, slogans, locations, telephone numbers, or internet addresses does not constitute advertising. Neutral identification that does not promote or compare products falls within this exclusion. Comparative or qualitative language triggers advertising treatment. When acknowledgement goes beyond neutral identification to include comparisons with competitors, endorsements of products, or qualitative descriptions promoting the sponsor, the payment becomes advertising income. Saying sponsored by XYZ Corporation is acknowledgement. Saying sponsored by XYZ Corporation, the best widget maker in the industry, is advertising. Calls to action and inducements to purchase create advertising treatment. Messages encouraging audiences to buy the sponsor's products, visit sponsor locations, or take actions that benefit the sponsor commercially constitute advertising. Acknowledgement informs audiences about sponsor identity without pushing commercial behavior. Exclusive provider arrangements may trigger advertising treatment depending on structure. When sponsors receive rights to be the exclusive provider of goods or services at events, this arrangement may constitute substantial return benefit beyond acknowledgement. The arrangement provides competitive advantage with commercial value. Unrelated business income tax, or UBIT, affects how nonprofits must treat certain sponsorship income. Understanding UBIT fundamentals helps you recognize when corporate relationships create tax obligations. UBIT applies when tax-exempt organizations engage in commercial activities that would be taxable if conducted by for-profit businesses. The tax prevents nonprofits from having unfair competitive advantage over taxable businesses. When nonprofits generate income through essentially commercial activities, that income may be taxed like business income. 3 criteria determine whether income is subject to UBIT. First, the activity must constitute a trade or business, meaning it is carried on for production of income from selling goods or services. Second, the trade or business must be regularly carried on, not just occasional or sporadic. Third, the activity must not be substantially related to the organization's exempt purpose. Sponsorship income may or may not trigger UBIT depending on how it is structured. Qualified sponsorship payments, as defined by IRS rules, are specifically excluded from UBIT treatment. Payments that exceed qualified sponsorship definitions may be subject to UBIT as advertising income or other commercial revenue. Advertising income is typically subject to UBIT. When nonprofits sell advertising in publications, at events, or through other channels, that advertising revenue is generally unrelated business income. The advertising activity is regularly carried on, produces income, and is not substantially related to most exempt purposes. Form 990T reporting requirements apply when organizations have gross unrelated business income exceeding $1,000. Organizations must file this form and pay tax on net unrelated business income. Proper classification of sponsorship versus advertising income affects reporting obligations. Properly structuring sponsorship relationships from the beginning prevents compliance problems and ensures appropriate treatment. Intentional structuring protects both the nonprofit and corporate partners. Clear sponsorship agreements define what sponsors receive for their payments. Written agreements should specify exactly what benefits the sponsor will receive, what acknowledgement or advertising will be provided, what access or hospitality is included, and what exclusivity, if any, applies. Clarity prevents disputes and provides documentation for compliance purposes. Separating acknowledgement from advertising allows you to identify which portions of sponsorship benefits are qualified sponsorship payments and which constitute advertising. When sponsors receive both simple acknowledgement and advertising exposure, the advertising portion may be subject to UBIT, while the acknowledgement portion is not. Separation requires intentional benefit design. Valuing benefits provided to sponsors helps determine appropriate treatment. What would the advertising exposure cost if purchased commercially? What is the hospitality worth? What value do naming rights provide? Understanding the commercial value of benefits informs both pricing and tax treatment. Fair market value considerations affect tax treatment when sponsors receive goods or services in exchange for payments. If a sponsor pays $50,000 but receives benefits worth $20,000 in fair market value, only $30,000 represents potential charitable contribution. The benefit value must be acknowledged in receipts and affects deductibility. Documentation for compliance and audit provides protection when questions arise. Sponsorship agreements, benefit valuations, acknowledgement versus advertising classifications, and rationale for treatment decisions should all be documented. When auditors or the IRS review corporate relationships, documentation demonstrates thoughtful compliance. Many real-world sponsorship arrangements do not fit neatly into grant or advertising categories. Understanding common gray areas helps you navigate complexity appropriately. Event sponsorships with mixed benefits characterize many corporate relationships. A company sponsoring a gala might receive logo placement, acknowledgement from stage, table for guests, and program advertising. Some benefits qualify as acknowledgement, while others constitute advertising. Parsing benefits to determine appropriate treatment requires careful analysis. Logo placement considerations include size, prominence, and context. Small logos and sponsor recognition sections differ from large logos dominating event signage. Logos appearing with comparative or promotional language differ from neutral logo displays. Context affects whether logo placement constitutes acknowledgement or advertising. IRS guidance provides some specificity, but judgment remains required. Sponsor hospitality and entertainment adds complexity. Event tickets, VIP access, meals, and entertainment provided to sponsors have commercial value. While some hospitality may be incidental, substantial hospitality benefits may affect treatment. The line between reasonable hospitality and substantial return benefit requires judgment. Cause marketing arrangements blend charitable support with commercial promotion. When companies promise to donate portions of sales to nonprofits, the arrangement involves both charitable and commercial elements. These arrangements have specific IRS treatment and state registration requirements that differ from simple sponsorships. Naming rights for programs and facilities create long-term relationships with complex implications. Multi-year naming arrangements involve substantial value that must be properly characterized and treated. The distinction between naming rights as acknowledgement versus as advertising depends on how the naming is used and promoted. Beyond technical tax distinctions, nonprofits should consider strategic implications of corporate sponsorship relationships. Financial benefit must be weighed against broader organizational considerations. Strategic considerations extend beyond tax treatment. What does this corporate relationship do for your organization beyond generating revenue? Does association with this sponsor advance your mission or simply provide funds? Does the relationship open doors to other opportunities or create limitations? Revenue is important but not the only consideration. Mission alignment with corporate partners affects authenticity. When sponsors operate in ways contrary to your mission, the association creates dissonance. Health organizations sponsored by companies contributing to health problems face credibility questions. Environmental groups partnering with polluters undermine their advocacy. Mission alignment matters even when dollars are attractive. Reputational risks of corporate association deserve attention. Corporate partners may encounter scandals, legal problems, or public relations crises. Association with troubled companies can damage nonprofit reputation. Vetting potential sponsors and considering how associations might affect public perception protects organizational standing. Maintaining independence and integrity requires attention when corporate relationships expand. Does sponsor influence affect program content, organizational positions, or service delivery? Are there implicit or explicit expectations that compromise independence? Healthy relationships allow nonprofits to maintain integrity while acknowledging partner support. Balancing revenue needs with values challenges many organizations. Sponsorship revenue may support important work that would not otherwise be possible. Declining problematic sponsors may mean program cuts. These tensions have no easy resolution but deserve explicit consideration rather than default revenue maximization. Understanding why corporations sponsor nonprofits helps you identify prospects, pitch effectively, and structure mutually beneficial relationships. Corporate motivations inform how to approach and serve sponsors. Why corporations sponsor nonprofits varies considerably. Some seek marketing exposure to target audiences. Others want association with causes their customers care about. Some focus on employee engagement through community involvement. Others respond to community expectations or stakeholder pressure. Understanding specific sponsor motivations helps you tailor approaches and benefits. Marketing objectives and metrics drive many sponsorship decisions. Corporations investing marketing dollars expect measurable returns. Impressions, audience reach, brand awareness, lead generation, and sales attribution represent common metrics. Understanding what sponsors measure helps you demonstrate value and retain relationships. Marketing-driven sponsors evaluate partnerships like other marketing investments. Employee engagement and morale motivates some corporate giving. Companies sponsor organizations where their employees volunteer, allowing workers to see corporate support for causes they care about. Employee giving campaigns, volunteer events, and community involvement programs connect sponsorship to workforce engagement. These sponsors may care more about employee participation than marketing metrics. Community relations and reputation drive sponsorship for locally focused companies. Banks, utilities, healthcare systems, and other community-anchored businesses sponsor nonprofits partly to demonstrate community investment. These relationships support the social license that allows companies to operate successfully in communities. Community relations sponsors may tolerate lower marketing returns for goodwill value. ESG commitments, meaning environmental, social, and governance criteria, increasingly drive corporate philanthropy. Companies face investor and stakeholder expectations for demonstrated social responsibility. Sponsorships that address ESG priorities help companies meet these expectations. Effective corporate partnerships require strategic approaches different from foundation grant making. Understanding how to approach corporate partners improves success rates and relationship quality. Research corporate giving priorities and history before approaching. What causes does this company support? What nonprofits have they sponsored previously? What do their CSR reports say about priorities? What community investments have they announced? Research reveals fit and informs how to position your request. Approaching companies whose priorities do not align with your work wastes everyone's time. Identify decision makers and relationship entry points. Corporate sponsorship decisions might be made by marketing departments, community relations staff, CEO offices, or local managers depending on company structure and request size. Who in your network has connections to the company? Who makes decisions at the level of support you seek? Entry through relationships produces better results than cold outreach. Customize proposals to corporate objectives rather than presenting generic requests. How does partnership with your organization advance what this company cares about? What specific benefits address their marketing or community relations goals? Customization demonstrates understanding and creates compelling value propositions. Offer tiered sponsorship levels with clear benefits at each level. Different companies have different capacity and different needs. Bronze, silver, gold, platinum tiers, or similar structures allow companies to participate at appropriate levels. Clear benefit descriptions at each tier help companies evaluate options. Build relationships beyond transactional requests. Corporate partnerships work best when they extend beyond annual sponsorship solicitation. Engage corporate partners in your work, provide updates throughout the year, invite participation beyond financial support, and treat the relationship as genuine partnership rather than just funding source. After securing sponsorships, fulfillment and stewardship determine whether relationships continue and grow. Excellent fulfillment protects and expands corporate revenue. Delivering promised benefits completely represents the baseline expectation. Whatever the sponsorship agreement specified, deliver it fully. Logo placement happens as described. Recognition occurs as promised. Hospitality is provided as agreed. Sponsors who receive less than promised become former sponsors quickly. Document benefit delivery for your records and sponsor reporting. Documentation of exposure and acknowledgement provides evidence of value. How many people attended the event where logos appeared? What circulation did publications with sponsor recognition achieve? How many website visits occurred on pages with sponsor acknowledgement? Documentation helps sponsors justify their investment internally and supports renewal conversations. Sponsor communication and stewardship maintains relationship between formal interactions. Updates on organizational work, invitations to non-fundraising events, and expressions of appreciation sustain connection. Sponsors should feel like valued partners, not just funding sources approached annually for money. Impact reporting connecting to sponsor priorities demonstrates that sponsorship accomplished more than marketing exposure. What mission outcomes did sponsor support enable? How did the program they sponsored affect community needs they care about? Impact reporting provides meaning beyond impressions and reach metrics. Corporate partners who feel genuine impact remain engaged longer. Renewal cultivation throughout the year prepares for successful annual asks. Rather than approaching cold each year, continuous relationship building makes renewal natural. Early discussions about next year's opportunities, feedback solicitation about partnership improvements, and ongoing engagement create smooth renewal pathways. Let us examine a scenario where corporate support takes multiple forms, requiring careful classification and handling. A regional bank wants to support your organization's financial literacy programming for low-income families. The relationship includes several components that require different treatment. The bank's foundation offers a $50,000 grant for your financial literacy curriculum development. This grant comes with typical foundation requirements: proposal, budget, reporting. It is a straightforward philanthropic grant supporting mission work. The foundation will receive acknowledgement as a program funder. The bank's marketing department offers $15,000 to sponsor your annual community event. In exchange, they want prominent logo placement, acknowledgement from stage, a table for 8 guests, and their logo on event materials. This is a marketing sponsorship with mixed benefits. Some acknowledgement is qualified sponsorship, while other elements may constitute advertising. The bank also wants to engage employees as volunteer instructors in financial literacy classes. This in-kind contribution provides valuable expertise while giving bank employees meaningful volunteer opportunities. The employee program supports both mission delivery and corporate employee engagement goals. Structuring and acknowledging appropriately requires separating these components. The foundation grant is charitable and gets grant treatment. The event sponsorship requires parsing benefits and potentially splitting treatment. The volunteer program is in-kind contribution with its own documentation needs. Each component requires appropriate agreements, acknowledgement, and reporting. The bank may receive different receipts for different components reflecting their distinct character. Organizations seeking substantial corporate revenue benefit from systematic approaches that build sustainable programs rather than pursuing ad hoc opportunities. Creating sponsorship inventory and packages catalogs what you have to offer, what events, programs, publications, and properties provide sponsorship opportunities, what benefits can be provided at each. Inventory development reveals the full range of corporate partnership possibilities and creates consistent offerings to present to prospects. Pricing sponsorships appropriately balances market value, organizational need, and competitive positioning. What do comparable organizations charge for similar benefits? What value do sponsors receive? Pricing too low leaves revenue on the table, while pricing too high limits participation. Research comparables and test pricing to find appropriate levels. Managing sponsor relationships systematically prevents drop balls and ensures consistent experience. Database tracking of sponsor contacts, agreements, benefit delivery, and communication supports professional management. Assigned relationship managers ensure sponsors have consistent points of contact. Systematic management enables scaling corporate programs beyond what ad hoc approaches support. Diversifying corporate revenue sources reduces vulnerability. Dependence on single sponsors or single industries creates risk when those sponsors face difficulties. Broad portfolios of corporate partners across industries and relationship types provide stability. Diversification protects against inevitable sponsor departures. Developing corporate partnership expertise within your team strengthens program capacity. Corporate relationships require different skills than foundation grant-making. Marketing awareness, benefit valuation, sales orientation, and corporate culture understanding all contribute. Training staff in corporate relations builds organizational capacity for this revenue stream. Today's lesson distinguished corporate grants from sponsorships, exploring the differences that matter for compliance, strategy, and relationship management. We examined how these categories differ fundamentally. Grants represent philanthropic support, advancing nonprofit mission without substantial return benefit to donors. Sponsorships involve business transactions where corporations pay for marketing value, brand association, or audience access. The distinction affects tax treatment for both parties and compliance obligations for nonprofits. UBIT applies when sponsorship benefits cross from qualified sponsorship into advertising territory. Comparative language, calls to action, inducements to purchase, and substantial return benefits trigger advertising treatment that may be subject to unrelated business income tax. Understanding these distinctions helps you structure relationships that stay within qualified sponsorship parameters when appropriate. Proper structuring from the beginning prevents compliance problems. Clear agreements, benefit documentation, appropriate classification, and professional tax consultation protect organizations from problems that are easier to avoid than to fix after the fact. Strategic considerations extend beyond tax compliance to include mission alignment, reputational risk, organizational independence, and values coherence. Revenue matters, but not exclusively. Thoughtful organizations consider what corporate relationships mean beyond the financial contribution. Systematic approaches build sustainable corporate programs. Sponsorship inventory, appropriate pricing, relationship management systems, diversification, and expertise development enable organizations to develop corporate revenue as meaningful component of sustainable funding models. In our next lesson, we bring together course learning in a capstone synthesis. Thank you for engaging with these important distinctions between corporate grants and sponsorships.